Welcome to Institute of Crypto. In this session, we will study crypto exchange-traded funds, or crypto ETFs. Crypto ETFs play a critical role in connecting traditional financial markets with the crypto ecosystem. To understand their importance, we must examine how they are structured and how they influence market behavior. A crypto ETF allows investors to gain exposure to cryptocurrency prices without directly owning the crypto itself. The ETF trades on a stock exchange, just like a stock or mutual fund. This structure removes the need to manage wallets, private keys, or custody risks, making crypto more accessible to traditional investors. Crypto ETFs generally fall into two categories. The first category is futures-based ETFs. The second category is spot-based ETFs. Although both aim to track crypto prices, they operate very differently, and this difference matters greatly for investors. Futures-based crypto ETFs do not hold actual Bitcoin or Ethereum. Instead, they invest in futures contracts, which are agreements to buy or sell crypto at a future date. These contracts must be regularly renewed, a process known as rolling. This rolling process can create costs that reduce long-term performance accuracy. Spot crypto ETFs hold the actual cryptocurrency. These assets are stored securely with regulated institutional custodians. Because the ETF owns the underlying asset, its price closely reflects the real market price. This structure is especially attractive to institutions seeking accurate exposure with regulatory compliance. A key feature of ETFs is the creation and redemption mechanism. ETF shares are created or removed based on investor demand. This process involves ETF issuers, custodians, and a special group of institutions called authorized participants. This mechanism keeps ETF prices aligned with underlying asset values. Authorized participants act as stabilizers in the ETF system. When demand increases, they create new ETF shares. When demand falls, they redeem shares and reduce supply. This process helps prevent large price gaps between the ETF and the crypto market. Liquidity in crypto ETFs comes from multiple sources. There is liquidity on the stock exchange, liquidity in the crypto market itself, and liquidity created through arbitrage. Together, these layers improve market efficiency and reduce friction during large capital flows. Tracking error refers to the difference between an ETF's performance and the price of the cryptocurrency it tracks. Futures-based ETFs tend to experience higher tracking error due to contract roll costs. Spot ETFs generally show lower tracking error because they hold the actual asset. For retail investors, crypto ETFs simplify access to crypto markets without technical complexity. For institutional investors, ETFs provide regulatory clarity, audited structures, and operational familiarity. This has enabled large-scale capital entry into crypto. Crypto ETFs have changed market structure significantly. They have increased institutional participation, improved liquidity, and strengthened infrastructure. Over time, ETFs help crypto markets behave more like mature financial markets. Crypto ETFs represent more than investment products. They represent the integration of crypto into global financial infrastructure. At Institute of Crypto, we focus on understanding these systems with clarity, structure, and long-term perspective. Subscribe to continue learning crypto beyond price speculation.